Live from the Business RadioX studio inside Renaissance Bank, the bank that specializes in understanding you. It's time for North Fulton Business Radio.
And hello, everyone. Welcome to another edition of North Fulton Business Radio. I'm John Ray, and we aren't back in our studio inside Renaissance Bank on Windward Parkway in Alpharetta, but we're looking forward to that moment in time one day soon. In the meantime, folks, the great people over at Renaissance are doing a marvelous job, really, in helping folks with PPP Round 2. We know this personally because of clients that we have that work with them, and they've done a terrific job. So if you need a more personal experience for your business, if you like a bank that's big enough to handle pretty much any need that you can throw at them, but small enough to do it in a personal way, I think Renaissance may be a sweet spot for you. They have been for me. So give them a call. Go to renaissancebank.com, find their local office, some 200 across the South, waiting and ready to serve you, and give them a call. And you'll find a individual there that can help you, that will actually answer the phone with a live voice, not a computer-generated one. And they'll be glad to be of service. Renaissance Bank, understanding you, member FDIC. Now I want to welcome return guest Robert Steele to the show. Robert is with the Steele Financial Group. Robert, welcome.
John, thank you much, sir. Great to be back. Thanks for having me. You know, sometimes you don't get invited back to some of these shows.
You're welcome anytime, pal. And folks cannot see your background, but you were talking about Cowboy Blue, so you might want to introduce yourself, tell a little bit about you and your background, but what you're up to right now. You're doing some good work.
That'd be great, John. Thank you. Yeah, background is kind of interesting. I got licensed to sell insurance when I was 19 years old, believe it or not. I was a sophomore in college. I was playing football at the University of North Alabama, and I was tired of those summer jobs. And that, you know, those real summer jobs where you sweated your tail off. And I decided to get my insurance license. I had actually just had my first knee surgery playing football at UNA. And long story short, I wanted to be able to have time to rehab and not be on a job site like I was for the previous 47 summers, felt like. And so I got in the insurance business, got my license, and actually, believe it or not, John, I received like $100 a month in renewal commissions all through college, all through playing pro football, and literally through, and I still receive a check, from all those, past sales.
I love it.
But anyway, long story short, I took a little sabbatical from the insurance business, came back, and again, rejoined the Steele Financial Group, which is a company that was started by my dad in 1952. So it's been in business a long, long time. And again, I love the insurance, employee benefits, financial services space. And, our goal today, John, is to really help bend the healthcare cost curve, in the U.S. because health insurance and healthcare are totally out of control.
I want to get into that in a second, but you have, I want to give a shout out because the last time you were on the show, you talked a little bit about the way you'd given back to your alma mater with the Steele Center for Sales, and I'm mangling the name, but talk about what you've done there, and let's shout that out for young folks that are interested in the field of sales.
Thank you for that, John. I am proud to be a part of UNA. I am on the foundation board for the university. I'm a significant supporter. UNA was, the old saying, UNA's been very, very good to me. And I do credit literally almost all the success I've had in life as from UNA. So Dr. Kitts, the president of the university, a few years ago, asked me if I would become a part of the Center for Professional Sales. And after some wrangling and weeping and gnashing of teeth, I agreed to do it. And so it is now called the Steele Center for Professional Sales. They initially wanted to name it after myself, and I just couldn't get comfortable with that. And knowing that my father was a salesman his entire life, I wanted to really name it after my dad or my family, and so it became the Steele Center. And the beautiful thing, John, is we have about 125 students right now in the program. It's a degree program in professional sales. We graduate about 25 students a year. We're the only accredited sales program in the state of Alabama, and there's about 47 accredited universities in the country. Again, we graduated 25 students a year, and believe it or not, John, every single one of those, 100% have a job waiting on them. Most have 2 and 3. One of our latest signees, if you will, went to work for Adobe in Utah. And again, these students go through significant training in their basically 2 years of their degree program, and they go through sales competitions. Kenneth, by the way, let me give a shout out to Kennesaw State and Dr. Terry Lowe. They have one of the premier centers in the country. And we have literally learned significantly from Dr. Lowe and Kennesaw State. But it's a great program. I'm honored to be a part of it, and I'm honored that UNA allows me to be a part of it.
Well, it sounds like it goes both ways. They let you be a part of it, but you give a lot to them too. So it sounds like they both of you benefit from the association. So that's awesome. Great work.
You, sir.
Yeah, great work.
Sir.
So let's talk about how you're serving the market out there with Steele Financial Group, and you've got some, I guess, developments really in terms of the ways that you help solve employer health cost problems.
Yeah. So the last time I was on, we talked mostly about healthcare and the Affordable Care Act and how things needed to change and change dramatically. And we were marketing, and we still are marketing, a medical cost sharing program, which is not insurance. It is a membership. It is half the cost of the Affordable Care Act product. And I'll give you a case in point, John. My first cousin, shortly after I was on the show, believe it or not, saw some of my posts on Facebook and LinkedIn and said, Robert, I'm right now with Blue Cross Alabama, $2,100 a month. I'm going to $2,800 a month, and I can't afford it. I just canceled my insurance. I said, no, Brad, you can't cancel your insurance. He said, well, I did. I said, well, then, let me send you some information. I put him on one of our medical cost sharing plans, and John, his premium went down from what it was going to $2,800 to $675 a month for a family of 5.
Wow.
That's a significant change.
Yeah. That's a game changer.
And so I started looking around the country because I've got employers, friends of mine, that were in the same situation, and medical cost sharing didn't work for them. And so I started, much like I do with any of my research projects, I scour the earth and find what's working out there. And I found a company out of Scottsdale, Arizona, that has developed an ERISA program. You may be familiar with ERISA. Those on the listening in, ERISA is the same chassis, if you will, that is what a self-funded health plan is. When an employer is self-funded, that's an ERISA plan. And so with that, it's the same plan that a retirement plan is a part. So your 401k is an ERISA plan. Your health insurance for self-funded is an ERISA plan. This is an ERISA plan, but it's an ERISA plan that's a fully insured ERISA plan in terms of there is no risk to the employer whatsoever like a self-funded plan might have. And so, John, the beautiful thing about this program is it's not quite half the cost as medical cost sharing is. It's about 30 to 35% less than traditional health insurance, traditional self-funded. And it's also designed to be a much more managed care program, and managed care from the standpoint of providing less out of pocket for a member, consumer, employee, and less out of pocket for the family. So our max out of pocket is only $5,000 versus traditional plans are more in the range of 10 to 15 to 20,000 family out of pocket. And so when you look at a premium of $349 a month for an individual and $999 for a family versus almost twice that in many cases, it's a significant savings. And I'll give you two examples. Employer in Massachusetts, 31 employees, we're saving them $185,000. Employer in Ohio, 175 employees, we're saving them $975,000. I can give you case after case after case, but it's a significant change because what are we doing differently? We're purchasing health insurance differently, and we're purchasing health care differently. We're managing that care much, much, much differently than a traditional health insurance company is doing it. It's not crazy stuff. It's just we're managing it differently. And I've said this on the call last time, John, you've got to purchase health insurance differently, and you've got to purchase health care differently if you're going to bend that healthcare cost curve for a consumer or an employer.
So let's back up for a second. And I mean, this may be self-evident to me and you, but I want to make sure we're clear to folks that are thinking about this. Talk about self-funded, that option, and what the risks are in a self-funded plan that you're trying to steer folks away from that it might be not be in their best interest.
So the interesting thing, and there are some by the way, there are some really good programs out there, John. And I'm not slamming. I used to be a TPA, and I paid self-funded claims, and I help people become self-funded. But you have to explain there are risks. Typically in a self-funded plan, John, you've got a spec deductible and an aggregate out-of-pocket maximum. So spec and ag, and when and I don't want to just get into terminology, but basically a typical spec for most employers is going to be somewhere between $30,000 and $100,000, and that means for a company with 50 or 100 employees, you could have a spec deductible on 4, 5, or 6 employees in a year. And that's a significant out-of-pocket expense because the reinsurance, what protects the employer from basically going bankrupt by being self-funded is what's called a spec deductible or an aggregate stop loss. And so the spec deductible is what the employer is responsible for. So if you think about a deductible, $1,000, $2,500, $5,000 deductible, that's the employee's responsibility. In a self-funded plan, the employer is responsible not for the deductible, the employee pays that. They're responsible for the specific deductible on a claim, on an individual claim on an individual employee or dependent. And that could be $50,000. And so the employer would have to write a $50,000 check, and let's say that, somebody had a heart attack and it's $7,500, $100,000. The employer has to write the first $50,000 if that's his specific deductible or her specific deductible as an employer. And then the reinsurance company would reimburse the employer the additional $25,000 or $30,000 above the $50,000 specific deductible. That is a significant risk to a small employer.
Sure.
Significant risk, especially if you had 1 or 2 or 3 issues like that in a single year. So what we wanted to do was we wanted to give you the flexibility of the self-funded plan without the risk of the self-funded exposure. And so we created this ERISA plan, and within that, it has no risk whatsoever, as does self-funded, from the employer's responsibility. So it actually almost acts similarly. It's not the same, but similarly to what we now know as a level-funded self-insured plan, where you're going to pay a premium. And let's just say in our case, it's $349 a month. It's $689 if you have an employee plus spouse, $689 employee plus children, or $999 employee plus family. And those are the flat rates. Once you pay that whether it be fully paid by the employer or paid by the employer and the employee in some combination, many cases, John, A good number of my clients will pay 100% for the employee and nothing for dependents, or some combination thereof. It could be 50-50. But once those two entities have paid that premium, then that's their highest out-of-pocket, maximum in terms of the business exposure to the employer. And of course, for the employee, it is also a very aggressive, managed care program from the standpoint of little to no out-of-pocket for the employee for routine and preventative care, and little to a total exposure of $5,000 family maximum out of pocket. So it's designed for. There's a number that was kicked out. You probably heard this number, John, and I'm blanking on which agency it was, but it was basically said that the average consumer has about $479 in their checking account for any emergency, and that could be an automobile, a house appliance. It could be a child health care expense. It could be anything. $479. Well, that's not a lot of money, and especially if you have to come up with that money prior to. That's why we wanted to have a health plan that had little to no out-of-pocket expense for the majority of healthcare expenses, and that's what we have.
You talked about folks, as we're sitting here chatting with Robert Steele. He's the CEO of the Steele Financial Group. Robert, you referenced this difference between an ERISA plan, and correct me if I'm wrong, but I think ERISA is regulated by the United States Department of Labor, so it's a federally regulated plan.
It is regulated by the federal government,
right?
Just like almost every other program in America, right?
Right. Versus the alternative is, buying, an employer insurance through your insurance company in your state that's regulated by the state. And you talked about the disadvantages of that. So yeah. let's dive deeper into that.
So the best analogy for that, John, is Amazon. Amazon sells one product all across the country, do they not?
Mm-hmm.
That is not the case with insurance. Insurance is controlled by the insurance commissioner in each state. So the insurance commissioner, in their infinite wisdom, decides that they want XYZ provisions of a policy to be in place, whether it be in Georgia or Alabama or Florida or California. And they put those provisions in because they think they know what's best for the employer, employee, and consumer in their state.
Mm-hmm.
And that defies the Amazon logic, if you will, of why wouldn't one product be good for everybody in the country? And that's not the case today with the Department of Insurance. Every single insurance company has to abide by the insurance regulations mandated by the Department of Insurance in that state. So United Healthcare has a different policy in Georgia as they do in Florida, as they do in California. And again, the same is true with Blue Cross in each respective state. The same is true for Aetna and Coventry and all the other big household names. They sell a different product in each state because of the insurance commissioner's mandates. And so with an ERISA plan, it's managed and governed by the Department of Labor. Therefore, we can sell an ERISA plan across state lines just like Amazon can. And so we have one product, not 50 products.
And there's a difference between, I won't say and you correct me as we go along here, hopefully, because I may get into trouble here. But when you're talking about an ERISA plan, there's a different level of regulatory scrutiny and requirement, right? That really keeps the employer more out of trouble. If is that a good way to put it or not?
Correct. Yeah, there's reporting requirements for ERISA plans, just like there are for any other plan.
Mm-hmm.
And so the Department of Labor, does do a great job of overseeing both the retirement plan programs that they manage, workman's comp programs that they manage, as well as employee benefit programs that they manage. So they manage all of those plus 1,000 more. And obviously, the country doesn't get upside down because they don't do a good job. They do a great job. And so I'm happy to be a part of, and every self-funded plan I've ever managed in the past was an ERISA plan as well. And so again, it is government regulation. It's just governed by a different entity.
Mm-hmm. Yeah. And there are some, I guess, some fairly stringent requirements for an ERISA plan in terms of the level of funding and the actuarial assumptions that are made by the plan and that kind of thing, right?
Absolutely. They have the same provisions of, having to be, not only compliant with all the regulations, but also secure from the standpoint of making sure that, everybody's keeping their promises.
Mm-hmm.
And so that really is why in a self-funded plan, a self-funded employer uses a third-party administrator to help them not only pay the claims, but to manage the risk with the specific and aggregate deductibles that is, a part of that arrangement. And so again, it is controlled and it is managed effectively, and that's why almost every employer with more than 250 employees, I would say 97.89%, John, use ERISA and use self-funded to manage their risk and their health care.
Okay. So, I guess I'm going to try to look at this from the employer's point of view, because, most employers look at this and all they see are the costs going up, and they don't, health insurance is such a hard thing to figure out for most lay people, right? Mm-hmm. And you're the expert on this. How do you respond to somebody who says to you, well, Robert, wow, this sounds great. Reducing premiums, let's say from $2,800 to $600 or $700, whatever the numbers are. That sounds too good to be true. Yeah, surely you've heard that a time or two, right?
Only every other conversation.
And aren't you glad I've asked that question again, right?
Absolutely. So let's make sure we're talking about apples and apples.
Right.
With that $675, $85 membership fee, that was medical cost sharing. That's for individual consumers and employers with less than 20 employees.
Gotcha.
They can qualify for those and participate in those programs. And those are sold all over the country. Mm-hmm. No issues whatsoever. The difference, John, when I get to an employer in our world of over 20, and we use this ERISA chassis for that, then here's the reason. This is where the rubber meets the road, John. This is what your listeners need to hear. In 2010, when the Affordable Care Act was passed, they passed a provision called MLR. Have you ever heard that term, John?
No.
Medical loss ratio. Have you heard that phrase?
Probably, but it wouldn't register with me. So keep coming. Yeah.
And it doesn't to most consumers,
right,
or most employers. Medical loss ratio. That's the number that the federal government said through the Affordable Care Act that an insurance company has to pay out in claims every year for it to be a viable health plan. So let's just say we're talking about $1 million here in mm-hmm. premium for an employer. Well, actually, $1 million would be 85% actually. But in a small employer, it's 80-20. In a large employer, it's 85-15. So let's just keep the math simple on the 80-20. And let's say we're dealing with $1 million for an insurance company. They have to pay out $800,000 in claims in order to be compliant with the federal government. Okay? Guess what happens if they pay only $790,000? They've got to figure out where to refund $10,000 across their entire book of business. Believe it or not.
Wow.
And so, and of course, that leaves them, John, with 20%, or in this case, $200,000 that they can spend on all their expenses, all salaries, all operating expenses, all profit, all everything, right?
Mm-hmm.
So when you are fixed in 2010, they fixed the game and said 80-20. Well, what happened in 2010 and 11 and 12 and 13 and 14 and 15 and 16 and 17, 18, 19 and 20? Premiums went up.
Sure.
Why? Because the 20% is fixed. They need a higher number for the 20% to be higher.
Mm-hmm.
Simple math equation.
Right.
This is where the game is, fixed against the employers who are traditionally insured. Their premiums are going to go up because the insurance companies want more money.
And the insurance companies are publicly traded, and they got
have you seen stock prices in the last 7 years?
They've gone straight through the roof, right?
Through the roof.
Yeah. Yeah.
I mean, I hate to say this. This is like Brer Rabbit. Don't throw me in that briar patch.
Right. Right.
They were against the Affordable Care Act for a good long time until the things started changing, and literally MLR and a few other provisions that, and obviously some of the government guarantees and things made this a bonanza for the insurance companies.
Mm-hmm.
Bonanza. So do you want to continue paying the insurance companies 20% higher? Because your 80% is going to stay fixed, whatever it is. So now, I mean, I hate to say it this way, they almost don't even have the obligation to manage healthcare better because they're going to have to pay out 80% no matter what.
Well, and they can blame the federal law, the ACA, and it's not their, we didn't do anything, right? It's just, it's the ACA.
We're just doing what we're told.
Right. And
your premiums just went up 20%.
Yeah. And higher stock price, as a result. So
CEO salary, I'm sorry, that almost correlates with the stock price.
Yep.
And the premium increase.
Yep. Okay, folks, if don't get mad about it, get even.
Just get even.
But yeah,
don't
right. Let's talk to Robert here. So Robert, I wish you would give one of your examples, because you mentioned it, you alluded to it earlier, but I wish you would give an example of the kind of savings that you're talking about for the ERISA plan. And that's, again, folks, employees 20 or more. So what are we talking about there? Give an example.
I've got a 51-person company in California right now that's about to sign up. We're at the closing table,
mm-hmm. and
about $250,000 in savings, to that 51-person employer. We got I mentioned the case in Ohio, mm-hmm. 175 employees, $985,000 in savings. And so again, there are plenty of situations it will not be as dramatic as that. There will be plenty of situations that might be a nickel or two more dramatic than that. But at the end of the day, it's going to be about a 25 to 30% savings off of traditional fully insured health plans and even some self-funded plans. And the 31-person company I mentioned in Mass was a self-funded plan, and it should have been. I would have done it differently had I been doing it before, but it should have been a level-funded health plan, self-funded, and they didn't even do that. And so when you don't manage the health care for a self-funded plan, you literally are letting the employees write a check out of your checking account. With no restrictions whatsoever. They can go anywhere at any time for any care at any cost. John, would you do that in any other phase of your business?
Don't think so.
Do you know that Mr. the wise sage that runs Starbucks Coffee. Do you know what he said about 2 years ago? Howard Schultz says, I spend more on employee health care than I do on coffee.
Wow.
Now, John, what is his product? Well, I know his product is experience. It's not really coffee.
Right.
But coffee is what gets people into the experience, do they not?
Sure.
He spends more on healthcare than he does on coffee. How much experience does a consumer at Starbucks get from the healthcare expense that he's spending? I would say close to zero. Would you not?
Sure. Yeah. The consumer doesn't care about all that.
No, because the employee's not, sharing the love on that experience.
Right.
So the issue is when literally, an employer, when they don't manage healthcare the way they need to, in order to bend the healthcare cost curve, they are literally giving an open checkbook to their employees to say, go wherever you want to go. Let me give you a case in point. I was on a self-funded plan in 2015. I had the misfortune of my athletic career catching up to me. I had to get a double knee replacement in November of 2015. I don't know if I shared this story with you, John. 2015, November 5th, double knee replacement. Very few people will do a double knee replacement. But I'm a healthcare consumer. So what did I do? I scoured the earth to find where I would get both knees replaced for the best possible outcome was my first goal. At the lowest possible price was my second goal. I looked at physicians and surgical centers and everybody all over the country, and I came up with 7, 8, 9 different solutions. One was 128,000 with average scores from quality standpoint, all the way down to 75,000 and 65,000 and 45,000 and 28,000. Which one do you think I chose?
Gosh, tell me.
I chose the 28,000 because it was what we call green. And I'll give you the website, healthcarebluebook.com. Healthcarebluebook.com, much like the automobile blue book. Healthcarebluebook.com.
Okay. I
went on healthcarebluebook.com. I found what we call a green provider. So green means go, does it not? So green is high outcome, high quality outcome, low cost. What would you think red would mean in a comparison of a physician and surgeon and facility?
High cost, and you don't want them working on you.
High cost, and you do not want to go there. It's like the Yelp restaurant review. We ain't going there, right?
Right.
So red, and so there are costing. So believe it or not, John, you can go there, and you can have literally some of the best medical care in the world, and in the same facility at the same time, a physician that is red. And again, I don't want to get in the weeds here, but all I can tell you is I got a 28,000 double knee replacement. I was walking the day I got, the day I got 3 hours after surgery, I'm walking, and it was painful, but I was walking, and it was $28,000 versus $128,000. Think about this, John. I didn't care after my $5,000 deductible. I didn't care what it cost. I don't have no concern about the cost, but because I'm a healthcare consumer, I wanted to be concerned about the cost. Because if I take care of all of my employers' expenses in healthcare, if I'm part of the solution, then our premium stays low for everybody. So that's why we have to do these things. By the way, I think you hear me getting a little passionate about this.
Yeah, you're worked up, man.
I love this stuff. I do. Actually, I'm a geek. I'm a sales guy, but I'm a geek sales guy. I love this stuff.
Yeah. Well,
So
and
there you go.
well, and that's what it's all about, folks. I mean, and we have folks like you and on this show in a variety of industries and that are doing great work and passionate about what they do. So there's nothing wrong with that. And we're glad that you're passionate about that because you're helping folks save money. because this is stuff that floats right to the bottom line for employers. So,
by the way, can I interrupt you one more second?
Yeah.
Gartner put out a report just a few months ago. I think a few months ago. It could be a little bit longer. For every 5% savings to the bottom line from expenses, guess what it equates to from a sales standpoint?
Tell me.
30%.
Wow.
A 5% bottom line savings equates to a 30% increase in sales.
Mm-hmm.
If I'm saving an employer 5%, I have actually helped them keep money from walking out the back door. They don't have to work near as hard next year to bring it in the front door.
Mm-hmm.
That's what this is all about. I mean, that's why I get excited, because I love sales more than anybody. Steele Sales Center. I love sales. I want to put people on the street. But I'm also passionate about keeping money from going out the back door. And the more we can keep it from going out the back door, the more healthy the company is, and the more they can do from every single aspect of the company. That's what this is. This is a holistic approach to, corporate governance as well as healthcare. That's why I get passionate about it.
Great stuff here from Robert Steele, and Robert is the CEO of Steele Financial Group. Robert, this has been great, and we need to I think at this point we need to let people know how they can get in touch with you, because you've got some things to tell them.
So I'm Robert at steelefg.com. So Steele Financial Group, Robert at steelefgfrankgolf.com, steelefg.com. And my cell phone, and I'm always available, 404-444-0457. And I've had that cell phone, John, probably 20-something years.
So you'll definitely pick up then. That's awesome. Robert Steele.
If I don't, I will return it. And texting works just as good. So awesome. Text, call, email. I'm happy to talk. I love talking this stuff. And what I love more than anything else is helping people figure out how to consume healthcare differently.
Mm-hmm. Well, Robert, this has been great, and I know there'll be some folks that are interested and want to be in touch. So let's give them that chance. Thank you so much for being with us,
John. Thank you for having me, and thank you for allowing me to come back. I've been not invited back. Not very. That hasn't happened.
Not from me, man.
Think about that, right? You're going to get invited back. So thank you for having me back.
Oh, it's great to have you back anytime, and you're welcome again. So we look forward to that and hearing more of your success. So thank you, Robert.
Thank you, my friend.
Absolutely. Folks, if you've got some administrative tasks in your business that are holding you down, we've talked about healthcare. There's also the business of you're spending too much time on an administrative task or bookkeeping or maybe marketing. Well, I've got an answer for you that involves picking up the phone and calling SES Cabito over at Office Angels. Now, they're not a temp agency or a placement firm. She's got angels that fly in and get the job done and fly out on an ongoing or as needed basis. And they've been doing this for 20 years virtually. So a pandemic does not scare them in any way. And my suggestion to you, if you're timid, go to officeangels.us and check her out and all that stuff. But I think what you really need to do is just pick up the phone and call her at 770-442-9246. Explain what your problem is, and SE either will pair you up with an angel who will take care of you, or she'll find somebody else that will. And I know that because I work with her personally on my business, and she does a fabulous job. So SES Cabito, Office Angels, 770-442-9246, and tell her that I sent you. Folks, North Fulton Business Radio, we're up to, 330 some shows that we've had over the last almost 5 years. We're going up on 600 guests at this point. And what I would really appreciate, and by the way, it's not about me. It's not about Business RadioX. It's about our guest. We would appreciate it if you would go and find the show on your local or on the app that you use, podcast app you use, whether it's Apple, Google, Spotify, whatever it is, and give us a 5-star review. It helps people find the show so they can use the services of great business leaders like Robert and be in touch. So if you could do that, we'd appreciate it. We'd also really value your connection on social media. North Fulton BRX is the search term on LinkedIn, Facebook, Twitter, Instagram. There's no telling what else they've signed us up for I don't know about. So go check us out on all those social media platforms, North Fulton BRX. So for my guest, Robert Steele, who is coming back, this is John Ray. Join us next time here on North Fulton Business Radio. And we're clear.